Bear markets can spell disaster for some investors, but there is a lot of opportunity to be found in them as well. And today we are going to discuss why maybe you should consider investing in a bear market. First, we need to make sure that we're all on the same page here, and that means we need to define what a bear market actually is. So the more formal definition is just a general, pessimistic or negative outlook on the general markets. Now, to try to get a little bit more numbers and a little bit more analytical in it, we like to say that when the market declines more than 20% from its recent highs, for 2 months in a row, then generally that is kind of well known as what a bear market is. So when a lot of people have just negative outlooks on the overall markets or on the economy, whatever it may be, and it's declined by 20% or more, that is generally what is known as a bear market. That is kind of like the generally accepted way of describing it. And there's a good reason why it's actually called a bear market. And it's really simply just because when a bear swipes its paw, it actually just swipes down. And so that is why when the market goes down for that amount of time and for that much, that is why it's known as a bear market. There are many different things that can actually cause a bear market to happen. Like for example, just general economic downturn. That can just generally cause the market to decline by more than 20%. In addition, there can be some major political events, usually negative political events that can cause it to happen. There can be periods of really high unemployment that cause the market to decline by 20% or more, maybe even a pandemic. So there are many different things that can cause a bear market to happen, but it's pretty much anything that greatly negatively affects the overall broad markets, whether that be the US market, the foreign markets, whatever it may be. Whatever affects whatever market you're looking at, that can cause a bear market, any kind of event that negatively affects them. So now that we know a little bit more about bear markets and what they are, it's probably important that we discuss, what some recent bear markets are. But before I get into that, I just want to say, so far, if you're liking this video, please help me out real quick. Give it a thumbs up, give it a like, helps me out, really do appreciate it. And consider subscribing to the channel and putting on that bell for notifications, because every single week I'm putting out new videos on personal finance. Currently I do Tuesdays and Fridays at 8 a.m. Pacific Standard Time, and there's just a ton of more information for you to learn and that I want to share with you. So please consider subscribing and like the video, really do appreciate it. But getting back to some more recent bear markets, in March of 2020, we did have a significant decline in the US market anyway, and actually the foreign markets as well. And we probably all know why, what the cause of that was. And then the next most recent bear market example was actually during the Great Recession. And again, I'll put up another chart for you right there. And that was between the years of 2007 and 2009. There are many different causes of the Great Recession, but it's generally accepted that it had to do with mortgages and the real estate market that caused it. Now, it's important that you do not confuse a recession with a bear market, because technically they are two totally different things. Now, they can be correlated. You can have both occur at the same time, but the exact definitions of them are different. The definition of a recession is different from the definition of a bear market, and that's because a recession is going to be measured by GDP, which is gross domestic product, whereas the bear market is simply going to be measured as a percentage of whatever index you are tracking, and the time frames within them are different as well. So in order to have a recession, you actually have to have 2 consecutive quarters of negative GDP growth. That would be actually 6 months. Each quarter is 3 months. Whereas I mentioned before that the bear market, you can determine a bear market from negative 20% or more of a drop from its highs for 2 months. So it only takes 2 months to show a bear market, whereas it takes at least 6 months to technically show a recession. But moving on to probably the most important part and the juiciest part is how to invest in a bear market. Because even though, when we're considering, let's say, the entire US stock market, if the US stock market is in a bear market, if it's experiencing declines of negative 20%, there is plenty of opportunity to be found in that. And one method that I have personally employed, and that might be a good idea for you to employ during a bear market, is to simply just continue investing in, say, broad-based index funds. That is what I invest in, and maybe you do as well. Because when you purchase, let's say a broad-based index fund that represents the entire US market, and the US market is down, let's say 25% from its highs, you can think of it as getting all of the market, getting all of that US stock on sale of at least 25% at that time. So that's when you need to look at the silver lining and look at, yes, there's a bear market right now and, stocks are down 25%, say, but there's opportunity in that, because if you were to buy it now, if you have some extra cash flow that you can still invest into the stock market, that's going to be, 25% extra returns for you once it returns to its high peak. And assuming that you think that, yes, the entire US will recover from whatever is happening at that time, at that point in time, then if you believe that to be true, then you should have no problem with, buying that stock or buying that index fund at that 25% discount. But there's another thing that I personally wouldn't do too much, and that is actually to gamble with individual stocks during a bear market. Because a bear market, it kind of just shows your losers and your winners when it comes to different companies. This is the time when a lot of companies will go out of business and shut down and never open back up again. Because if they can't remain profitable or remain afloat during a time when everything is bad, then that means that they won't be there long enough in order to be there in the times when things are good. So if you are I would say gambling and just investing in individual stocks, just trying to make some fast money once the market recovers, you wouldn't want to, say, invest a majority of your money into that, because that would be just speculation. And from an individual investor standpoint, it's very difficult to, pick those winners every single time. So even if you did pick one winner, there's probably going to be, 4 losers that you also picked that are going to negate any kind of gains that you got from picking that one winner. Now, if you are just doing some of that, say, for fun, using some of your fun money, where if it's just money that you actually don't mind losing, then there's definitely no problem with that. But if you're investing, like, say, for your retirement, if you are putting money into these individual stocks during a bear market, it is very, very risky, and I personally would not do that with my own retirement funds. But if you are investing in a broad-based index fund, say a mutual fund that tracks the entire United States stock market, you cannot really lose on that deal, because as long as you believe that the entire United States will come on top and will make it out of whatever bad situation it's in at that point in time, then you will recover. Then if you believe that to be true, then you will get that 25% margin back to its highs, whatever it may be. Whereas if you are picking individual stocks, there almost is no guarantee, because it's all dependent on that one company. And if that company goes insolvent and shuts down for good, then all the money that you invested in that company is going to be gone, as a common stockholder. And so that is why during a bear market, you should still be investing, if your strategy is to invest in broad-based index funds. Everything is practically on sale. And looking at a historical chart over the long period, I'll put that up on the screen right now, you can see that there is plenty of times when the market has gone down, when we've had bear markets, when we have gone down in value by more than 20%. But so far, we have always recovered, and I believe that to be true for many, many years to come. And if you believe that to be true as well, that the United States will come out on top, then investing in a bear market, in one such as a broad-based index fund, should be an easy choice to make. Now, this doesn't mean that your journey to learn more about personal finance and becoming a master of your cash flow has to end here. If you haven't already, please make sure that you watch this video that I made. I put a lot of work into that video, and that's because it's chock full of great information on how to become a master of your cash flow. It's called How to Achieve Financial Independence in 10 Years or Less. And it's basically a blueprint, almost guaranteed, to growing your net worth over time. Thank you so much for watching this video. I'm Zach from uncashflow.com, and I hope to see you next time.